It doesn't matter if you've been investing for decades or are just getting your feet wet. We're all trying to solve the same puzzle. What's the absolute best way to make our money grow? It's a question that's led to some Nobel Prizes and, well, some pretty spectacular failures. Let's dive in. The second you decide to invest, you're basically standing at a fork in the road. Do you take the safe path for a slow, steady, and pretty predictable return? Or do you swing for the fences, right? Chasing those huge gains, but also risking a major strikeout? That's the fundamental choice every single one of us has to make. So in one hand, you've got something that's almost perfectly certain. A government bill is going to give you a guaranteed return, but let's be real, it's not going to make you rich. And on the other hand, you have something like the S&P 500 with the potential for massive gains, but it comes with a ride that can be, well, let's just say it can be a little stomach churning. So where's the sweet spot? And this is where our story gets really interesting. Back in the 1950s, this economist, Harry Markowitz, comes along with a truly game-changing idea. He created a logical, mathematical process for investing, and in doing so, he basically invented what we now call modern portfolio theory. The real secret sauce behind his whole idea was one powerful concept: diversification. His huge insight was that if you mix together different investments that don't all go up and down at the exact same time, their individual movements start to cancel each other out. And what that means is you can actually lower the total risk of your portfolio without having to give up your expected return. It really is the closest thing to a free lunch you'll ever find in finance. So, Markowitz's work was huge. It laid the foundation for a whole new way of thinking about how to price stocks. It was elegant, it was logical, but, as we're about to find out, it had one teeny tiny major flaw. This new model was called the Capital Asset Pricing Model, or CAPM for short. And what it tried to do was boil down all the chaos and complexity of the market into one single elegant number: beta. Simply put, beta just tells you how much a stock tends to move up or down when the overall market moves. It's the kind of risk you just can't get rid of through diversification. And the theory itself is beautiful in its simplicity. It predicts this clean, straight-line relationship. The key takeaway is this: the more market risk you take on, meaning the higher the beta, the higher your expected return should be. It just makes sense, right? If you're taking on more risk, you should get paid more for it. So it's simple, it's elegant, it's perfectly logical. But here's the billion-dollar question. Does this beautiful academic theory actually work when you test it against decades of messy, real-world market data? Well, when researchers finally crunched the numbers, the answer was a massive, resounding no. The beautiful theory was completely broken. In the real world, the low-risk, low-beta stocks actually delivered higher returns than they should have, while the high-risk, high-beta stocks just massively underperformed. It was the literal opposite of what the theory predicted. The whole thing was turned on its head. Okay, but here's where it gets really exciting for us as investors. This failure, this giant gap between the theory and what actually happens, it wasn't a problem. No, it was a massive opportunity just waiting to be discovered. You see, this gap is called a market anomaly. It's a pattern in the data that, according to the old textbooks, just shouldn't be there. And this discovery basically created a whole new school of thought called factor investing, which is all about building strategies to systematically take advantage of these anomalies. And that brings us to the two heavyweights, the two most famous and powerful factors that have come out of this new way of thinking: value and momentum. So first, you've got value investing. Think of this as the classic bargain hunter approach, right? The style of legends like Warren Buffett. You're trying to find great companies that just look cheap. Then you have momentum, which is almost the opposite. It's more of a ride-the-wave strategy. It's based on that old physics idea that an object in motion tends to stay in motion. So you buy the stocks that are already winning and you sell the losers. And when you look at the historical evidence for value investing, it is just jaw-dropping. Over long periods of time, the cheapest stocks have just crushed the most expensive ones. This huge performance gap is called the value premium, and the old CAPM model has absolutely no way to explain it. All right, so it's one thing to know that these powerful factors exist, but the real question is, how can you, as an individual investor, actually use this stuff? So let's walk through a simple way to put these ideas into practice. And look, this is not some new, flashy trend. This is a time-tested strategy. It's the same exact one used by absolute legends like Warren Buffett and the guy who taught him, Benjamin Graham, to build their massive fortunes. What's great is that this system just boils it all down into these really clear categories. A-ranked stocks, they're the cream of the crop. We're talking financially robust companies that are trading at what looks like a fantastic price. B-ranked stocks are also strong contenders from financially sound companies. And if it's unranked, well, that's your signal to just move on. It either means it's not a good value or the data just isn't there to make a good call. Now, I know what you might be thinking. Digging into all the financial reports, the valuations, the price history. For any single company, it can feel like, whoa, that is a lot of information. But here's the thing. We can slice right through all that complexity. It all comes down to these three things. First, the company's financial health, which we can see with a financial stars rating. Second, we're going to look at its recent price history. And third, we pull back for the big picture with something called the value graph, which is super helpful because it combines several valuation methods all in one place. Okay, let's get practical. Section 3 is your 4-step investing guide. This is where we put all that theory into practice. So here's our game plan. Step 1, we find a list of potential stocks. Step 2, we start refining that search, narrowing it down to the best of the best. Step 3, we get really detailed with the value graph. And finally, step 4, the one people always forget, deciding when to sell. All right, step 1. This is all about finding potential stocks to look into. And you can use search tools to do the heavy lifting for you to automatically sort and filter for companies that already meet some of those basic criteria for good financial health and good value. And here's a little pro tip for you. As you're searching, keep an eye out for stocks that have both a good value rating and a good momentum rating. Finding a company that's a good deal and also has positive price trends, that's the holy grail. I mean, we're talking less than 1% of all stocks here. So when you see one, it's definitely worth a closer look. So, moving on to step 2, refining your search. I absolutely love this analogy because it's so true. If you were valuing your house, you wouldn't just use one number, right? You'd look at different methods to get a clear picture. And it's the exact same idea with a stock. So here's what you're going to look for. First, those financial stars we talked about. If you're more conservative, you'll want to see more stars. Second, check the price history. Is the current price sitting below its recent averages? That could be a sign that has room to climb back up. And finally, and this is crucial, check the date on the data. You want it to be fresh, ideally less than a month old. Okay, time for step 3. Here's where we get detailed by analyzing the value graph. This is our chance to zoom in and see the big picture of how different valuation models are viewing this one stock. Now, the absolute key here isn't to get hung up on any single number. What you're really looking for is a consensus. See, each bar on the graph represents a different way of valuing the company, so you want to see if a bunch of them agree that the stock is undervalued. The more bars you see sitting above the current price, the better. It means you have a bigger margin of safety, more room for error in your investment. And that brings us to the final step, step 4. You have to know your exit strategy. Finding a great company at a good price is amazing, but it's only half the battle. A truly successful investor always knows when they're going to sell before they even click the buy button. And look, your exit strategy, it's going to be personal. It depends on your goals. You might decide to sell once the stock isn't on sale anymore, when its price climbs up to meet one of those fair value estimates. A more conservative investor might decide to sell a bit earlier, just to lock in a smaller but safer gain. The important thing is that you have a plan. All right, let's move into our final section, the patient investor's edge. This is maybe the most important skill of all, and it has nothing to do with charts or numbers. You've probably heard this famous quote from Warren Buffett, and it just perfectly captures the idea. The stock market is a device for transferring money from the impatient to the patient. It's all about patience. You see, finding a great deal, an undervalued stock, that's just the start. The next part, and honestly, sometimes the hardest part, is just waiting. It can take a while for the rest of the market to wake up and recognize the true value of the company you found. Your patience is your ultimate advantage. And really, that is what this all boils down to. The tools, the techniques we've talked about, they can help you find incredible opportunities. But at the end of the day, real success in value investing often comes down to temperament. So I'll leave you with this question. Are you ready to be a patient investor?